Hello, everyone, and welcome to the first episode of the Macro Microscope series. Today's topic is higher for longer. I'm one of the speakers, and I'm Indrani Day, Head of Global Investment Research at FTSE Russell, London Stock Exchange Group Company. And I'm joined by my co-speaker, John Dioufas. He's Director, Data Stream and Macroeconomics at the London Stock Exchange Group. A quick disclaimer, we are not an investment advisory firm, so everything that's mentioned today is not investment advice. It's purely for educational purposes. So now I'm going to hand it over to our first speaker, John.
Hi there, Indrani, and hi, everybody. My name is John Dioufas. As Indrani said, it's a real pleasure for me to be involved in the inaugural episode of the Macro Microscope. I'm really excited with what we're looking to do going forward. As you said, Indrani, when you first gave the idea, let's call this higher for longer, I got really excited. 2024 was meant to be the year of central bank rate cuts across the board. Everybody had priced in rate cuts. For the Federal Reserve, between 3 to 5 rate cuts. Some of the more ambitious souls were even hoping for 6 rate cuts in 2024. We're now in June, and we find ourselves in a position where the Federal Reserve has not yet cut a single rate, potentially has one scheduled for September. The Bank of England potentially has one scheduled for September as well, but nothing is certain. When we look at the key driver for US consumer inflation, on this chart, what we see is basically government deficit. From 2020, so from the beginning of the pandemic, when the US government increased its stimulus to keep the economy going, since then, the blue line, which is a deficit, shows a leading effect for consumer inflation. And now that we find ourselves in an election year, it's highly unlikely that the US government will cut spending before the election is done. So it's also very likely that US inflation will remain sticky. But when we move across the Atlantic and we go to the European Union, to the Eurozone, and we look there, what we see here is that the Eurozone inflation was driven by the natural gas benchmark, the TTF, the transfer title facility. And that was very much to do with partly the pandemic, but also the conflict in Ukraine, the war in Ukraine. But what we've seen since then is that the gas price has come down and inflation has followed, and kind of makes you think that the ECB is looking at this and thinking, inflation in the Eurozone is sort of coming under control slowly but surely. So we had our first cut with the ECB in the first week of June. When we go to the UK, there it's a completely different story. What we're looking at the UK is the driver inflation there is too many jobs available, but not enough people with which to do it. So that blue line is the ratio between the vacancies and the unemployment rate. And we see as that goes up, as that ratio increases, so do the two forms of inflation in the UK, whether it be the consumer price inflation or the retail price inflation. This seems to be sort of coming off to the point where maybe the UK can consider cutting rates, but they would really want to see the decrease in wage inflation take place first. And the last one, before I hand over to Indrani, we're looking at the forward inflation-linked swaps for 5-year and 5-year basis. And for all of those, we see that basically the ECB's got the least concerns because its forward forecasted inflation is coming down quite nicely towards its inflation target of 2. The US as well, but the UK is a little bit more sticky. So it'll be very interesting going forward. Thank you, Indrani.
Thank you, John. So I'm going to take a slightly longer view, and I'm going to concentrate on the United States simply because it's the largest economy and the reserve currency. So let's look at what is the Fed projecting for the long-run neutral Fed funds rate. And that's the chart on the left. These are nominal numbers. What's interesting is after having stayed at 2.5 percentage points for a very long period of time, those estimates went up earlier this year to 2.6%. And in the June meeting, it went up to 2.8 percentage points. What is also interesting is if you look at the range of the estimates, both the top end and the bottom end estimates have gone up, which means essentially the Fed thinks there is a long-term push to the neutral rate for the United States. On the right-hand side is, again, the Fed funds rate, but from the market's expectation point. And using data from the futures market and the swaps market, the interesting point is that in the near foreseeable future, the market does expect the Fed funds rate to remain north of 4 percentage point. So it's much higher than in the GFC to COVID era. Now, on to the next slide, what I want to highlight is while till now we were talking about the Fed funds rate, but for financial markets, what really matters is the US 10-year Treasury. For both financial markets and the real economy, that's really the foundational rate. And there, the chart on the left that I want to highlight is this term premium, which is a very critical input into the 10-year yield. The Fed funds rate is one input into the 10-year yield. The Treasury term premium is another very important input. And the term premium, which was in negative territory for a very long period of time, starting from about 2016, is now at just about zero, which means from the term premium component itself, there is almost a 1 percentage point push to the 10-year Treasury yield in the long term. Now, what does it mean if rates remain higher, as we are seeing they probably will, given what's happening on the Fed funds rate and the term premium? I think the implication is if rates are the price for capital, a higher price will potentially lead to better capital allocation, which could then potentially lead to an uptick in productivity. And there are some signs from the US economy that productivity might be ticking up, which is what the chart on the right-hand side shows. That is all for today's episode of Higher for Longer in the Macro Microscope series. So thank you all for joining.
Thank you.